Hello and welcome to another episode of the Leverage Podcast. I'm Paul Richard, your host, and we're welcoming Matt Graham today with us. He's with Home Mortgage Group. Matt, welcome to the podcast today. It's good to have you on.
Paul, thanks for having me. I really appreciate it.
We've had some great conversations leading up to this podcast. I've really enjoyed getting to know you better and understanding a little bit more about your business. And obviously, I've been in touch with the real estate business quite a bit. So I love that we get together and talk about this. So give us a little bit of your background. What led you into the lending world, and talk to us a little bit about that.
Oh, man. Long story short, I grew up the son of a pastor and a teacher. And here in I went to Nixa all my life. I was a 13-year senior here at Nixa, which is in Southwest Missouri. My dad had a church over in Ozark that he built back in the early 80s, right after I was born, pretty much. And then he grew that up to be a pretty good sizable church. So I was always the kid that was running around having to entertain, pastors' kids or missionaries' kids or, anybody in the church that needed help. I was the youngest of four. So it kind of fell on me to go do all these things, which helped me out later on in life. But being a son of a teacher and then a pastor, it gave me quite a different upbringing that most people wouldn't have, I think. A lot of it was hard work, but honestly, it was more about how to treat people, how to be around people, not sales, but just really having that servant's mentality of always wanting to help people no matter what. So that really goes into lending, I think, more than anything that I do, really, because that's just really what I strive to do every day when I wake up. It's my family first, and then I worry about my clients, and my team too. So but I went through life playing sports, always trying to outdo my other siblings, and they were all older than me, and they were all athletes. So I was always trying to outdo them. So I found the one thing that they couldn't do, which was hit a fastball. So I learned how to play baseball quite well, and went to college. Was talking to the Chicago White Sox and the Colorado Rockies, and was a pitcher. And then one day, my shoulder didn't quite like the workout I was doing, and my ligament gave out. One of my ligaments in my shoulder gave out, and I was pretty devastated by that. But my sister had always been in real estate. She was a realtor for a couple of the big realtors here in Springfield. And I was laying on the couch. I was sobbing. I was just distraught. Didn't know what I was going to do. And I just came home from college, and she had one of her friends that was at the house at that point. And she came in, and she was great. And she said, "Well, have you thought about being a loan officer?" And I was like, "No. What does that do?" And she gave me the rundown, and she was working with a guy at the time that owned his own mortgage company. And so she called him right there on the spot. She said, "Hey, I've got a guy. He's green as all be, but he can learn. He's a go-getter. He knows how to talk to people." So he had me come in for an interview, and he trained me on how to do loans. Learned the ins and outs of it. He was an underwriter, not just a mortgage guy. He was an actual underwriter. So he would get his own files. He would underwrite his own files. And then, so once he taught me how to do that, I went into, I wanted a little bit more, I guess would be the case at that point. Plus we were in a weird point in the times. So this would be like 2005 or so, 2006. And so I went to Wells Fargo for a number of years after that. So I kind of split off from him, went to Wells Fargo for a long time. And then the recession of 2008 didn't really hit my area, which is Springfield, Missouri. It didn't really hit us until about 2009 or so, closer to 2010, really. And whenever I saw subprime mortgages become a thing, I thought, "Oh, this is not going to be good," And
Yeah.
Wells Fargo created those, and so it was. I saw the writing on the wall coming, and then once that happened, I decided I wanted to take a break. So I went into heavy commercial construction with a friend of mine's dad, and then went for a long time doing that. And then, a freak accident happened, and I broke my back, and I was sitting there And I was thinking, why am I not in the mortgage business? Like what am I doing? Why am I not back in it? This was supposed to be temporary, and here we are, 7 years later, still in construction or whatnot. And so I decided to get back into it, and was really happy I did. A lot had changed since I left. I was like, you got to get a mortgage license now? Like, what is all this? Uh, which I'm glad we do. And so I decided to go back, and I got my mortgage license, worked for another friend of mine for a little bit at his mortgage company. And then I got recruited by a local bank to come on board there. And then I worked with, banking for the next, oh gosh, what? See, so that'd be about 8 years or so. And then I decided that, I didn't really want to, I was giving a lot of my loans to where I'm at now, which is Home Mortgage Group. I was getting to where I was saying no to a lot of people, and I was be like, okay, well, go talk to my friend Jason, who's the one who taught me how to do loans at the very beginning of all of this. And I just decided that if I'm giving all these loans to someone else and he's able to get those done, then what is keeping me here, at a bank? And nothing wrong with the bank. I did a lot of business there, loved everybody there, but I just thought, as far as my being able to help people, and I don't like telling them no. So I decided that I would just put the banking aspect to the side and go back to a small mom and pop shop, and be right next to my underwriter. And so I've been there ever since. And really, it's been great. I love having my underwriter sit right next to me. I send out an application, and he's technically the first one that even looks at it. So I've curated this to where I've taken out almost all the guesswork right up front. I've got a guy that he basically takes the application, he pulls credit, he vets the file, he goes, give me this, give me this, give me this, and I go get that, and then he spits out an approval letter. We don't just give pre-approval letters anymore. We give a conditional approval letter, which means that now that we've done all of our homework on this person, and it might take just a smidge little bit longer to get them their approval. Not much, though. If I have to do maybe a written verification of employment or something, that's about as far as I have to go to get something done. That's a little extra, but anyone's going to have to do that along the way. So we decided that we're going to do it up front. So that way there's no surprises, because most of the time I would hear people coming to me and I'm having to save their file. And it's because the loan officers didn't do that step of something like a verification of employment can kill a deal. And they're doing it, 2 weeks after going under contract, and they've got maybe 2 weeks left to be able to close on this house. And now all of a sudden they're having to tell somebody no because maybe their verification of employment doesn't match their information they put in the file, or maybe it doesn't match their paycheck stubs. There's a lot of different factors that go with that we have basically just taken all of that off the table. And so I sleep a lot better at night. I know that. I don't have to worry about something blowing up on me or turning into a disaster, 2 weeks after we, get under contract. So it's been just an absolute blessing to have. Plus, I have more ammunition too. I've got more products that I can sell, which we'll talk a little bit more about. But I didn't want to give that a huge, long spiel about this, but I really feel like it's important because I've been in the business so long that I got to the point where I was beating my head against a wall of, why can't we get this loan done? It looks good on paper, but why are you telling me no at this point? And so now I don't have to worry about that. We've got a system in place now that I don't have to do all of the, well, why? Why are we doing this? Why do we do it this way? Why can't we just do it what the guidelines say? People have overlays. Lenders have overlays, is what they're called. So you have your guidelines, and then you have a bank or whomever you work for, or the lender that you've got the loan locked with, and they've got an overlay that says, well, the guidelines say this, but we've got something additional on top of that we need to make us feel better about this file. And so that I got kind of tired of as well. And so we don't have a lot of overlays with, the place I'm at now. So Home Mortgage Group has been an absolute blessing to me and my family, really, because I have more time to spend with them. Plus my files are a whole lot cleaner. They're a whole lot easier. But even just like today, a lady calls me, when was that? Friday night. She called me at like 7 o'clock. She basically called me crying and said that she had talked to two other lenders and they slammed the door in her face, is the way she said it. And was crying, was getting to the point where she didn't know what she was going to do. She was up against a time constraint. She had to be out by September 30th of her rental, and everybody said no because her credit score was down below 600. She was at 582, I think. And so everybody else said no, but it's a VA loan, and VA plays by a little different ball game most of the time. But again, that's where you're getting into those overlays, because VA doesn't necessarily have a credit criteria, so to speak. I've even seen we've even done loans we did a loan for a guy that had a 429 credit score. It depends on a lot of different factors, but in the last 12 months, she's had great credit. She's done everything right the last 12 months. So as long as that's occurred, yes, she might have a little lower credit score, but I was able to get her approved. So I was literally on the phone with her, which is why I delayed you, because I was talking to
Yeah.
her. But this time, instead of tears of fear, it was tears of joy that she was giving me, which is like the reason why I get up in the morning. You know what I mean? So that's what I live for. So I love that I could call her and give her the basics of it. Now it's just a matter of what she wants her monthly payment to be, and we can work her purchase price down from where she has it now. So.
That's totally awesome. I love it. There's a couple myths that I overcame early on in my career. One was that you have to have three lenders, right? There's this
Right.
big thing about having three lenders. I started out with Remax, and they told me that. Not that it was, I understand they were trying to mitigate risk, right? So bottom line was, very soon after that, I found a lender in St. Louis that I absolutely loved. And they do anything for me. And I said, you're getting all of my business, right? And so what happens is the trust is so good, and they know, hey, you're my one person. So as a lender, when a realtor says, hey, you're getting my whole flow, whether they do 10 deals a month or they do one deal a month, that is, you're going to be like, okay, when Paul calls, I'm going to answer the phone. I'm going to, jump on this thing, get his done. You know what I mean?
Yeah.
Rather than saying, oh yeah, I'm looking at three lenders and we're going to, you're just throwing you in the mix. Well, you're not going to waste your time. It's, well, at least most of the time. And so anyway, I realized I'm actually less risk because I know it's getting more attention to my client, from your lending standpoint at that. And so every lender I've worked with is said the same thing after that. Is like, yeah, I knew, I could trust that you give me all the business that you possibly had. And sometimes you go through times when you have all cash deals, and it's like, I'd love to give you some deals, but these are all cash deals, and especially during the boom time during COVID, it was like that crazy, right?
Oh
But
yeah, but it's what you said was hugely important, because it's all about relationships in this business. And I get there is a steering aspect of it, which is why most people have three. But there's a tactful way for you if you've got a lender that you're an advocate for, which I suggest every realtor should have at least two that they're an advocate for, because you never know when you're going to need that second one. And
yep, yep.
I am the second one a lot. But that's because I don't pay for people's advertising. I don't pay for leads and stuff like that. I'm just a guy that they know they can call if something goes awry with their other lender. They can go, hey, well, my second guy usually gets it done, but my second guy doesn't have all the bills that my first one has, with paying for leads on realtor.com or whatever. And so I kind of pride myself in that, because I get a lot of different realtors that call me all the time, and they're like, hey, I need this saved. I think you're the guy to do it. And usually we get it saved, or we at least get them on a roadmap to get it done.
Well, that's true. And like, for example, for a while I had one lender that could not do non-warrantable condos, and I had one that could do non-warrantable condos. So we had an agreement that, hey, if it's in this category, it's coming to you. If it's in this category, it's coming to you. And I'm all about full disclosure. I mean, I just tell them this is the way it's going. I mean, hopefully, you can handle the truth here. If you can't, then we probably shouldn't work together, because that's the way we're. And they're like, yeah, this is good, and
Yeah.
that type of thing. Of course,
At
being in
least you had a
Branson, yeah,
roadmap, at least. Yeah.
yeah, and being in Branson, we have there's 7,000 non-warrantable condos down here, so there's a lot of that going on. In fact, like 10% of them are on the market right now. It's unbelievable. Yeah, we got
Wow.
700 in Taney and Stone County. We have 700 condos on the market right now. So I mean,
Wow.
it's a
Wow.
it's a chase to the bottom right now in that
Well, and
market.
that's a dangerous place to play, because there for a while it was a race to the top, because
Yep.
and I think I know what happened was people started traveling a lot, back before COVID. And they started looking at these Airbnbs that they were staying in, and they start running numbers. And they're like, well, shoot, $190 a night. If I rented it out, X amount of nights per year, that would pay for the mortgage for the year. Now, if I make any more on top of that, I've got, X amount of income I could make. So everybody got this thought in their mind of, well, I can come up with the 20% if I had plenty of people that did this, trust me, that they would do a cash out refinance when the rates were super low. They did a cash out refinance to go buy that condo that they thought was really good done at Disney World. And then they get 2 years into it and they're like, oh, this thing's not renting as much as I thought it would. I'm barely scraping by or whatever. And you get to the point now where I even told my wife, I was like, you watch, give it 2 to 3 to 4 years, and you're going to start seeing people get tired of being a property manager, and it can wear you down real fast. Trust me, when you get those phone calls at 10 o'clock at night that the toilet seat's loose, or they can't use the hair dryer because there's a GFI that flipped and they don't want to touch it because it's electric, and so it can wear you down real fast. Trust me.
Absolutely. And really in Branson, what I noticed was, okay, so before COVID hit, there was maybe 200 on the market, that type of thing. And it was fairly good market for rental. And of course, then when COVID hit, you couldn't go on a cruise, you couldn't go to Europe, you couldn't, really get on an airplane half the time, if you didn't want to wear a mask or something. And so everybody's going, let's just drive to Branson, and so it was boomtown, and so your numbers on your rentals looked fantastic, and so they started building more. And in fact, I had one deal where they bought it pre-construction. It was around 700,000, and at closing, by the time it's done, they probably could have sold it for 1.2 million. It wasn't even, just because it just flip it. And we were selling contracts like crazy like that. Well, then COVID gets over, options start opening up. You can go to, cruises again. Cruises are booming right now. In the travel world. And so suddenly, and then gas is up there like $4 a gallon. We're a drive-in tourism place. So if you're looking at the weekend and you say $4 a gallon, it's going to run me $250 to drive to Branson from Des Moines or something, you might go, well, let's just not do it, and that kind of thing. So a lot of that has been happening, right? And
Yeah.
so we're very affected by that world. And then the management companies, they're trying to discount them to try and get night stays, in there.
Yeah.
And so it's really tough, really, really
Oh
tough.
yeah.
And it'll shift, but right now it's a real tough market in there. But the
Yeah.
homes are just the opposite. I don't know. What are you seeing in our market for homes? Give me an idea, sub 250, 250 to 400, maybe 400 and above. What are you seeing in the sales market right now for our area?
Gosh, it's tough. It really is. Location is the key, and
Yep.
I see it above 400. Sometimes I see it sitting for a little while longer than something that's in the 180 to 250. And I say that because a lot of our business right now is first time home buyers. The people
Yeah.
that have to buy something, the people that graduated college, now they've got their job, they've been there a while, they're done renting, they've watched enough TikToks that maybe they even want to do the house hacking, where they get a duplex and they rent out half of it. I've got a lot of young guys that are doing that right now. they're buying it with FHA loans, and they live in one side and they rent out the other side, and it's a great play. It's a smart play to do it that way versus just buying a regular single family residence that you're having trouble making the payment on. But maybe they rent the basement to their buddy or the other couple rooms to their friends or whatever. I see that a lot right now too, and I wish more people that were younger would see that they can do that, which is a great place to be. But duplexes are hard to find too. If you're looking at maybe in Springfield, it's a different market than Branson, but I feel like in Springfield you're looking at like the 260 or so to buy a duplex. That's not even like a fancy duplex. If you're in Nixa, that $400,000 house might sell within the first couple weeks. If you're in Ozark or any of the big, areas like Springfield or Nixa, Ozark, that 400 probably is a pretty sweet spot. Once you get further out, that 400, it might sit for 3 months before it gets sold. But I see that 180 to 250 mark's a pretty sweet place to be. For a single family residence, because like I said, you're going back to either people that are downsizing from that $400,000 house. They want a cheaper payment. Kids are gone. So I'm going to move into something that's like 250, 260. Or you have the first time home buyer, back to that again. And I would say that a lot of it is first time home buyers. I'd say just looking at my pipeline alone, I would say I've got, two or three, let's just say out of 10, I've got two or three that are selling and buying, and they're all in that 450 or so, 500 range. I've got another four or five that are first time home buyers. And then I've got, four or five that are investors. So I would say you're back to and guys that are buying rental properties or duplexes, triplexes, and then people that are first time home buyers. So between first time home buyer and investor is a large majority of my business right now.
That's very interesting. And you were talking about a loan that I wasn't as familiar with. You were talking about this DSR loan. Can you go a little deeper into what is it? How does it work? And it sounds like you're pretty excited about it. So tell me a little bit more about that.
Man, I tell you, out of all of the investment loans I'm doing, the DSCR loan has been the one that, whenever I came on board over here, it was one of those things that I had to have them research because they hadn't done a lot of them. They knew that a couple of our investors did those. So I said, hey, before I, come out of the banking world, let's do some research and let's get the best ones that we can find on the market to be our investors for these. And, the DSCRs are their debt service coverage is what that is. That's what the DSC stands for. So as long as the mortgage is paid by the rent or, and I'll say we can even do non-mortgable condos with these too. So non-mortgable condos, you can do 20, 25% down on something like that. This is strictly for rentals. But as long as that mortgage is paid by the rent or even on those non-mortgable condos, they can use their DNA to look for speculative rent. Plus, we send an appraiser down. They do a 1007 market rent analysis, which tells us what the average rent would be in that area. Missouri is a little bit tougher because it's a non-disclosure state, so it's hard for appraisers to kind of get an idea, but they go back onto these property manager websites. They can look around and find out what this duplex is renting for pretty quickly. And so, like I said, as long as that's paid by the rent, then you're good to go. And that includes your escrows, of course. So, but we're in a really good area of the United States to where you can still get a rental for under 300,000 and still charge that, $1,800 a month or so for something like that, maybe $2,000 a month. And as long as you're putting the correct amount of money down, you're still able to make that happen. And if you're putting down 20%, you're not getting a very great rate. You're not getting the best rate you could get. 25 to 30% down, you get a much better interest rate. And I'll give you an example. So I've got a conventional loan. This is almost apples to apples. I've got a conventional loan on a non-warrantable condo. One person's buying one as a second home, so it's a conventional. Basically, it's non-QM loan, but it's on a conventional status, not DSCR. So, buying it as a second home, you take a little bit of a rate hit. But even as an investment property, you take a little bit of a rate hit. But on a conventional second home, this one person is putting down 30%. They're still at 7.125. I've got a DSCR loan that's a cash out refinance up to $160,000 this lady wants for this, and I'm getting her at 6.875. So the rate is actually even better than a conventional loan, which is crazy to think about. But it is what it is. They do have prepayment penalties that go along with it that you don't hear those terms very often on loans these days. But that is to help you get a better interest rate too. So they do 1 and 2 year and 3 year on the prepayment penalties. And I find that if you do a 2 year prepayment penalty, it's 1 or 2% of the loan amount, depending on various factors. But that can help drive that interest rate down. I think with hers, I only did a 1 year prepayment penalty on that. And she's doing a cash out refinance on it. So 6.875 should have praised for somewhere around 250,000 or something like that. So, I wouldn't think in a million years that any investment loan would be a cheaper interest rate than a conventional loan. So,
Yeah.
but
Is
that's the
there,
glory of these.
yeah, is there any in the state of Missouri? Are there any programs right now to help first time buyers? What's the situation there?
Yeah. So, first time home buyer loans, there's a few. They kind of seized back on those after COVID, for, sake of most banks had some kind of incentivized first time homebuyer loan. Like the bank I was at, they had 100% first time homebuyer loan, had no mortgage insurance. It was a conventional loan. As long as you had above a 680 score, you pretty much walked into a house for free. A lot of the first time homebuyer loans these days, they have, and that means as long as you've not owned a home in the last 3 years is what that's designed for. So you don't have to be first time ever buying a house. It's just within the last 3 years, you couldn't be on title or on a mortgage of any kind. So they do down payment assistance on some of these. MHDC is probably one of the most heavily used, and that's a Missouri product that, you have usually what they do is they base these off of FHA. So you'll do FHA is a 3.5% down loan. So they'll combine that 3.5% down. They'll take that 3.5% and they will be the ones to cover that gap. So that's basically your down payment assistance. So the caveat to the MHDC loan is that it is prorated for 10 years. So you've got to stay in the house for a full 10 years before the entire 3.5% is forgiven, is what they call it. Now, when you're there 5 years, yes, it'll be half of what it was, the 5 years previous, but you technically have to be in that house for 10 years before all of it's forgiven. And that's one of the biggest factors I talk to people about, because most people don't stay in their first time home for 10 years. A
Right.
lot of times they're in and out. They want to be out in 3 or 4 years. Maybe they start making more money. Maybe they graduate from college. Now they've got the better job, what have you. They're usually, I think what the national average is 6 years, 7 years before someone's out of it. So you still have a little bit left on that loan to be forgiven before you can say it's paid off. So most people forget that, though. So let's just say we get into a situation where, like right now, sometimes we're starting to see some appraisals going backwards from what they bought that house for back during COVID. So not only did you walked into that house for free, great. Now what happens 5 years later when it's not appraising for what you bought it for, and you feel like you've got too much going on with this house all of a sudden that you can't pay all these things, and your AC just went out and all these other things, and you're trying to sell it. Well, you've got realtor fees of 6% that you've got to worry about. Plus, now you've got that extra little bit of that down payment assistance that you've got to pay back too. So it kind of puts you in a little bit of a bind to think about that over 5 or 10 years, going, gosh, how much of that is still on there? I mean, you really never know until you run title work and you find out, what's left on it. So, but it's a good thing for most people. I will say that it's a great loan. Now, I've got a loan at Home Mortgage Group that is a down payment assistance loan, but it's Basically, it's a 100% loan. You can combine it with FHA. And it's a second mortgage, essentially, is what it is, which I kind of like that better because you can pay that off if you throw a little bit more at it. And say in the first 5 years, you could pay that 3.5% off and be able to just say, that's my down payment. It's gone. It's already spoken for. Now I've got that 3.5% equity that I didn't have before. And you can pay it off much faster than not having that option, because with MHDC, you don't have that option to pay it off. It's just there and it's forgivable and it's prorated. So there are a couple different first time home buyer loans. Now, you do have what's called Home Possible and Home Ready, which those are designed to be a conventional loan. So as long as you're above a 680 credit score, it's a 3% down loan instead of FHA at 3.5%. Your interest rates a little higher than FHA, so that's kind of why I feel like if someone can come up with an extra, 0.5%, you might be able to save more on the interest rate. Now, both of them have mortgage insurance attached to them. So with Home Ready and Home Possible, it's a little bit lower rate for the mortgage insurance. So as far as the weighing those options is always difficult because you've got to really run the figures and say, okay, well, is first time home buyer option with Home Ready or Home Possible, is it technically better than FHA? Because with FHA, I'm getting a better interest rate, but the mortgage insurance rate might be a little higher with FHA than it is with these other two options. So ultimately, it boils down to which one's just going to be better for you in the long run. Ultimately, they're probably going to be pretty similar to each other. But if I'm a half a point higher on the interest rate with Home Possible or Home Ready than FHA, maybe I'm saving more money overall with FHA. Either way, I tell people that these loans are usually temporary, especially with interest rates the way they are right now. No matter which way we go, and I'll always provide those options to people. Here's the first time home buyer loan, and here's FHA. Which one do you feel like after seeing the numbers you want to go with? I'm never going to force them to go with whatever. With FHA, you don't have to take a first time home buyer class. With Home Ready or Home Possible, you do have to have an online course that you take. It's really some videos and you answer, a couple questions. That's really about it. But then you get a certificate. I have to have the certificate. So there is a little bit extra you got to do to get it. So yeah, if you're going to go as far as taking all these courses and stuff, I want to provide you with some answers first, so you don't go wasting your own time just taking a little bit of a course or something. But
Sure.
either way, they're all great loans. I'm really happy that we have even a 3.5% down option. But I also like for people to have a little skin in the game too. To be quite honest with you, Paul, I feel like that situation of buying a house and then all of a sudden maybe it's not appraising for what you bought it for. That's a scary place to be. So I always like if someone can come up with 5% even. I love having a little bit of equity walking into something.
Absolutely. Absolutely. And the rates, so the rates you've been mentioning a little bit, we talked earlier. Um, what's been in 2026? What have you seen on the rates? And, there's a lot of uncertainty in the market, of course, but what are you seeing moving forward? I love what you do as far as counseling. It's like, hey, hopefully things will get settled down again and we'll be able to go and do some refis. You mentioned you had a lot of people teed up for refis. Can you kind of walk us through what's happened this year with the rates and what you're seeing right now?
Sure. I mean, this year, gosh, since COVID, I feel like I've been on a roller coaster, Paul. I
Yeah,
feel like I'm without like any belt holding me in, and I know there's some loops coming up. I just don't know when they're going to be because I'm blindfolded. Um, and so COVID was great because we were in this decline, right? It was just like, when do I catch it at the lowest I can get it for this person who wants to go right now? Now I'm going, gosh, I had at least 50 or 60 people um, that bought a house in the last 2 years or so when rates did go up, that are just sitting waiting to refinance. And I always tell people, if we can get a 0.5%, let's do it. Most of these people we're talking, they're going to be above 300, 350, 450, 5, 600,000. If you're up in that range, 0.5% can be a lot of money that you can save monthly. So I use that as my, just as my rule of thumb. Um, but once and we were starting to look like we were on a pretty good pace. Right around February, I started seeing rates coming down. I was like, cool, great. March is going to be good if it continues on this trajectory that we're on. The markets were looking good. The economy was looking good. Inflation was still high. Unemployment was still low. So that's our two biggest factors is inflation and unemployment. And we got to the point where everything was starting to look great, and then we got into an altercation in the Middle East with Iran, which I'm sure everybody knows about. I don't like to get political, but it is what it is. Once we started seeing that occur, then obviously everything else started going up too. I mean, we were on a great path coming down. Once that happened, everything overnight almost just shot straight back up. So back to our all-time highs, pretty much. Um, I am seeing some anomalies as far as like FHA loans. FHA loans were on a really great trajectory coming down, and I can't say that they've really been hugely affected by it. They've stayed fairly low. Conventional rates are just terrible right now. Um, like I said, I've got an investment property loan that's lower than a conventional loan. I never thought I'd ever say that. Usually it's the opposite. But FHA loans, I even got somebody approved at 5.99 not very long ago. I mean, a few days ago, with she was putting some money down, but great credit score, great income. There were some other factors that had that part of it that helped out tremendously. But I didn't see the FHA rates going straight up like I did with all the other loans. Any government loan right now is pretty good. USDA is pretty good too. I'm still seeing that in the low sixes, which is great, but that's another 100% loan that like I said, we're in a unique area that I can still use USDA loans and still be only 20 minutes from downtown Springfield, so
Yeah.
it's really nice having that. And we do a lot of those loans. We do a lot of manufactured housing as well from these newer home builders that are modular homes. We do a ton of those with USDA, and I'd say we're still in the low sixes, about 6.375, 6.25 would be a pretty decent number to use, and that's without buying any points. And we'll talk about that in a minute. I really want to hit on that because it's really hard for guys like us to not get shopped to death by these online brands. Um, and is it too early to start talking about that, or is that a good segue?
Yeah, that's a good segue. Yeah, I mean, I think about my first home purchase, and it was in Nebraska, and it was we did buy down the rate back then. I think the rate was 12% at that point. We bought it down to like 7, yeah, and that kind of thing. But yeah, and then there was refi opportunity. We got back down again, but anyway, yeah, let's talk about that. Well, I have another question really before
Yeah.
I go to that one.
Yeah.
So there we have a new Fed chairman, right?
Mm-hmm.
And is that really going to affect much, or what do you see there? Do you see much in that
You know,
going on?
the Fed chair can only, they're just, I mean, they're almost, I hate to say they're like the president, but they're more of a, they don't control as much as we think they do as a chairman. It's a whole committee that goes into this. It's a whole. I mean, it's the Fed. It's a huge organization, is what it is. And they have to rely on the counseling that they get from everybody within that company that tells them, hey, this is where the market's at. And really, in their world, they don't just get to make decisions that they feel in their heart is the best thing. They have to go by analytics. They have to go by what is the market bearing. What are those contributing factors that do control interest rates? It's
Yep.
not just
Yep.
they don't just pull this stuff out of the clouds and go, well, I feel like I can bring it down to X. It has everything to do with the data that they're getting from society in general. So what is
Yep. Yep.
inflation looking like? What is unemployment looking like? They want unemployment to be at 4% or higher. We're not there. We aren't even close to it. And that's one of the major factors that they talk about. Inflation, they want it to be at 2%. We're hovering between 2 and 3, which is probably the first time that any of us have been able to say that in the last 5 years. So having inflation coming down is great. awesome to have it. Unemployment, though, it just means that there needs to be more people unemployed, and it's the craziest thing that anyone can hear me say, because every time I say that, people look at me like I have four eyeballs. And it's just, that's the sad part, and that's the reality of the market that we're in with real estate, is you've got to have more people unemployed so they can take advantage of lower rates. That's the whole point of all of this. If
Yep.
if the market's doing really well and everybody in society seems to be doing well on paper,
Yep.
they're not going to do us any favors. But a Fed chair can't just come in and just have this magic wand that says, well, the president wants me to do this, so I better do it.
Yeah.
I mean, you saw how
Right.
that went for the last one. The last one, he stood his ground and he said, "No, I can't do it. It's not me. It really isn't me. I'm just a chairman who says what is everyone else is putting in front of me." So, if we could get there, great. I feel like even with inflation being high and unemployment still being low, I still feel like there is a middle ground, but you got to think too, we got spoiled during COVID that, we got down to, I got people locked in at 2.5% on an interest rate. I think they felt like after that, if you went ahead and took advantage of that, great. You're not going to see it ever again. This was a short period in time that it was necessary to do it. The problem is some generations, some people got spoiled by that and thought it was the norm. Like you said, you started out at 12%. My parents told me they built a 4,000 square foot house on 3 acres in one of the most up and coming places called Nixa, Missouri. And
Hmm.
back in the 80s and 90s, it was a boom town. And they built a 4,000 square foot house for $70,000. Their interest rate was 18%. But you could build a 4,000 square foot house for $70,000. Now
Right.
you wouldn't be able to build the garage for that,
Right.
So
Right.
it's a give and take. But yes, now I do have people that also look at me funny because they've never heard that you can buy down an interest rate. That's probably one of the biggest keys right now that I tell people, that if you're say putting down $150,000 on this house, maybe you don't have to do that. We can get you to where maybe 5,000 of that you put toward the interest rate, and we get you down into the fives.
Yep.
From say 7.125 as a conventional loan. Let's just say you take 5 or 6,000 of that, put it toward the interest rate. We can lower your payment faster doing that than if you were to put down another $20,000 on the principal. So you can go a long ways just by buying an interest rate down, by spending a little extra money. When I have people that, they argue with me about, well, I want to put more money down. I want to get that payment down, and I'm going to put more money down. That's how I do it. Well, not really. I mean, yes, we can, but I can get more bang for my buck out of you just buying down the interest rate, which leads me back to, when people shop lenders, the first thing they do is they pull out their phone and they Google, what are interest rates today on a 30-year loan? Well, that just gives you all these companies that say, yes, we're at, let's just say, you can look online right now and you'll see, 6.5 on a conventional loan, or 6.375. But if you look down at the bottom where it's got this really small, really light, fine print, and
Yes.
it'll say, that's with 40% down, a loan amount of $160,000, 800 credit score or higher. And that's also with buying a point, which means you're spending at least 1% of that loan amount is going toward the buy down of the interest rate. So what you need to look at is the APR. If that APR is much higher than the interest rate, there's a whole lot of fees that are getting added to it. So that's your key, number one. Number two would be, that's not realistic. It's just
Yeah.
not.
Right.
Most people I know that are buying a house, like I said, most of them are first time home buyers right now. Or if they're lucky enough to have a sale and buying another house, I'm like, yeah, let's just buy the interest rate down with a couple grand. You're in a good position. Most first time home buyers that are pulling their phone out looking at rates, they can't do that. There's no way they're
No.
going to have 5 grand to go put down toward an interest rate. So, most of those people are doing down payment assistance programs. So they don't have money to put toward that interest rate. So whenever I tell them, it's going to be, your interest rate is X, they're like, oh gosh, well, how come it says online? Okay, let's break that down real quick online. I can tell you how to get to that point. but it's going to cost you X to do it. And as soon as I tell them that, then it makes sense in their mind because they're in the situation and now they see everything in front of them. When they're just shopping and still talking about buying a house, they get attached to those rates a lot. They really do. And it makes a lender's job, who's a local lender that they're starting to talk to, it makes it kind of difficult to explain it because when they see all these other companies that show all these rates and then you tell them something different, then it's really conspiracy theories and all sorts of stuff that start coming out. Trust me. But as a local lender, we have the advantage to be able to at least sit in front of you and tell you all these things. You try getting a loan through any of those online companies, and good luck to you.
Right. Right. Yeah, that's crazy. And so that that idea is kind of new for the first time home buyers, the folks. So we're kind of almost doing a generational re-education, right? Because
There you
we
go.
lived how many years with 3% ish rates, and it was, everybody got used to that, right? We all
Yeah.
got used to that. And then now it's like, ooh, what's going on?
Yeah, never
It
double
feels
that.
different. Yeah, it feels different, and that kind of thing. And it's just like during COVID when everybody was, fighting to buy a house, you barely got the sign in the yard, and
Yeah.
it was multiple offers, selling over list price, and people are like, I hate that, and then now it's like, my house is going to sit on the market for 90 days at least. And they're like, well, I hate that, So yeah, what do you want? I mean, it's going to go back and forth and you can't play it. You really can't play the market because
No.
especially if you're going to sell and buy in the same market, you're going to face the same headwinds or tailwinds that you have at that point.
Yeah.
Right. So
And it's really just about guidance. It's people like you and people like me that we just have to guide people and give them the options. Give it their best shot at getting what they want. The problem I'm finding is that people are having to stretch themselves pretty hard right now. I have so many people that I talk to on a monthly basis that they want that $1,000 monthly payment, and that's really difficult to find.
yeah,
Unless you find something off market, or you have a friend that's wanting to sell and they're going to sell it to you for X no matter what, which is very rare. But it's just really difficult to put some of that in perspective to some people where sometimes they give up, and I hate that too, because now they're still going to go find that apartment for $1,000 isn't that great either, and so it's
right.
what do you do? You try to work harder, you try to do better, you try to improve your credit score. There's a myriad of things you can do to try to help yourself. One of the biggest things I tell people though is at least try to save some every single month, $50, $100, something. Put it somewhere, whether it's a money market account where it's interest bearing, or at least a savings account until you can get to where you can open up some kind of money market. But be prepared. Also, if you're a parent, do your kids a favor and teach them about this stuff.
Yep. Yep.
Credit wise, get them going when they're 16 or so. Put them on as an authorized user if you can at the earliest age that you can do that. Get them taught about this stuff because I do have some people that their parents taught them how to do this stuff, and they're buying houses at 18, 19, 20 years old.
Yeah.
Um,
Yeah.
and that's because the parents got them ready for it. But you know what? If you're not buying a home, you're not building equity. Once you build equity, there's so many things you can do with it. It's basically like your own emergency fund. If you get enough equity, you can get a home equity line of credit. You don't have to use it, but it's there in case you need it. So if you need tires for your car, something like that, and you don't have $1,400, you do now because you have equity in your house. You can use your
Right.
house as a great asset, as its own bank, basically. And that's what I love to educate people on too. So there's just so many, and even if you have a rental property, you can take a line of credit out after you've had that rental property showing that it's income producing for 2 years. Usually you can do it after a year, but usually banks want you to have that property for 2 years. They'll do a line of credit on that property. You can use that as income that's not taxable by the IRS because it's a loan, it's not true income. So
Yep.
there's lots of different ways to get what you want out of life. It's as long as you're positioned properly and you have the right people around you.
I love that. I love that. Well, Matt, this has been awesome. We're going to have to do another podcast just to expand on some of the stuff we talked about, I think.
Anytime,
And yeah, we'll
anytime.
have a chance to talk. We're going to get together live and in person tomorrow. I'm looking forward to that as
Can't
well.
wait.
So, hey, people are going to want to get in contact with you to talk to you about their situation and hopefully buying a house through you with your lending.
That'd
What
be awesome.
is the best way to contact you? What,
My cell
online
phone
or
number is the best way to get a hold of me. It's
okay,
always on, and you never know where I'm going to be. I do a lot of networking. I do a lot of stuff with the city of Springfield, the city of Nixa. And so I'm constantly doing some stuff. I'm not always in the office, but that's a good thing because I'm always trying to find different ways to help people.
sure.
But my cell phone number is 417-209-8532. Save it, use it, give it out to people. I'd love to be able to garner enough new people to where I could do some type of online Zoom first time homebuyer class or something like that if there's enough interest in it. But you know what? If anybody just needs questions, if they've heard something, if they've put in an application with another lender and they're hearing things, that's just like this lady with the VA loan we first started talking about. She had two people at least slammed the door in her face, told her she'd never own a house. I just got her approved and she's going to buy a house. Um, so just because someone tells you no, I love starting with those. If someone's told someone no, definitely call me and let's talk it through why that happened.
Okay, that's awesome. All right, Matt, thanks again for being with us, brother. It's been tremendous. We'll look forward to talking to you very soon.
I appreciate it.